Hello. In this video, I will try to just give you an idea about return on investment, which is ROI. Maybe you find it. Maybe you have an idea what is it. It means just if you do an investment, how much can you get in a year? Okay. They say, for example, just in general, that if you take the S&P, Standard & Poor, it gives you around 12% yearly. This for 20 or 30 years before. Okay? Just by buying the index. You buy the index and you leave it. Okay? It's like an ETF, or you buy a mutual, an ETF, most of the time, ETF. Okay? Because this ETF is following the SP 500. Okay? So, you get 12%. Now, you know, the people, or wherever you go for investing or investment, if you go to the books, if you go to traders or investors and something, they always think about the past as the future. And this, by itself, is a wrong idea. How can you think you see the past today? This is today. And this is the future. Okay? We see that the past, for example, is 12% each year. Just an example. Now, in 12% year by year. Now, you see the future. You think that you can get 12% in the future, year by year. I will tell you this. Who can guarantee this? Okay? Ask any mutual fund manager or ETFs, and you want to invest your money. So, what you do? Ask them this question. It's a question. Can you guarantee me 12% yearly? Okay? Can you guarantee me 12% on my investment, which is return on investment? Do you think that someone will guarantee this? No one. Okay? Why no one guarantee this? Because no one knows the future. No one knows the future. Knows the future. And people, this is what astonishes me. People are still thinking that the past is the future. Okay? People or investors or traders, they always get confused in this idea of investment. They think that you put your money and 10 years after, you will get 12% yearly, as in the past. Okay? All the studies shows that there is a growth, okay, of investment. But you don't know how much is the growth or how much you will lose. Okay? That's why, what is the thing they give you? They always say this, another solution, diversify. Diversify, it means your money, put them in many stocks, mutual funds, and other stuff. You diversify a lot. So if an investment go down, the other will go up. So you will have some money always. Okay, in general. Now, I will give you an example, some examples that sometimes when we have crisis, there is always a risk. That's why mutual funds and ETFs, if you go and read their information, they say to you, there is a risk of losing money. No one will guarantee your money. Okay? Why the mutual funds, they say that always there is a risk. Risk in the future. Okay? There is always a risk in the future to lose money. Because no one knows the future. And the second thing, they don't want to be responsible for your money. Okay? No responsibility from them. No responsibility. I will give you a funny example in order to understand this, this risk. You are here. Another one is here. Okay? This guy, this is you. This is another one. Another one. So this guy asks you, give me money. Let's say $1,000. Okay? Give me 1,000. You give him $1,000. He tells you, I will take, as an example, 3% for fees. Okay? And take 3% for fees. 3%, it means he will take $30. He will take $30 for your money. And he will tell you, I will invest for you. Okay? You don't invest directly, but he will invest, he is the middleman. Okay? He is the middleman. He tells you, I will invest this money in the stock market, but I will take my fees. Now, in general, who has the sure money? This is a sure money here. The fees, commissions are a sure money. This middleman is anyone who has a mutual fund, brokerage firm, ETFs, anyone like this. Let's say sure money. This is called profit. For example, anytime you make a trade, for example, the trade, when you buy, it's $5. You sell $5. So he is making money for sure. Now you bet on the stock goes up or down. The profit is unknown. You may win, you may lose. So, who is making the gambling here? You or the brokerage firm? Apparently, you are gambling. He is doing business. Okay? He is doing business because he gets profit. Whatever happens, he gets profit. Now, you gamble because it's 50-50. It's 50-50. You buy today. Tomorrow, maybe you get some money, maybe you don't get. Okay? But he is getting profits. Now, mutual fund. This is, for example, when we speak about, this is like a commission. And there are other fees. Okay, other fees, you can, some platforms have excellent platforms, we have news, you should pay extra money for this information. For example, for the news, they sell you the news, okay? And they are getting a sure money, okay, sure money. Now, this is like in general brokerage firm. Now, if you go to mutual fund or ETFs, the companies that issue this is the same thing. They take their fees, it's a sure money, they are making profit. That's why. If you go to check how much money, how much profit, these brokerage firms, institutions, banks, they're always making profit because for them, they take always something for sure. It's a sure profit. Most of the time. Not all, but most of the time it's sure profit. Now, if you are an investor or trader, always we have the big risk. They have less risk than you. That's why they make money and the future you don't know. You make or you don't make. Depends. Depends on the stock market, depends on the thing. Okay? So, how can someone, when they see return on investment and I see numbers that's online, I just laugh. How can you think about return on your investment when the future you don't know what will happen? So for me, you should never think about this return on investment until you see the money. You buy after 1 month, 2 months, or 1 year, 2 years. When you see the money, this is return on investment. This is something that you can sell, you get the money. Okay? Now, I will tell you a funny thing about brokerage firms. This is in order to show you how risky is investing and trading. Margin accounts. Okay? A margin account is you have some money, they double it, and you use the brokerage firm money. Okay, they ask for an interest rate. Okay, let's say for example 4%. Why this brokerage firm they ask 4%? Why they don't invest their money and they invest their money since they know better than you, since they know what's going on inside? Okay, they don't, because they want a sure thing. A sure money. This is return on investment. They want something that it is a sure thing. It's calculated. But you cannot calculate your return on investment since you don't know the future. You don't have some money that it is like an interest rate or you are sure about something. You will never be sure about something. That's why some are always making money, others are not, yes, in general, you don't know. 50-50. But those, it's not 50-50. They're always making fees, commissions, whatever. Okay? So, thank you very much for watching this video. If you have a question on this return on investment that you do, please just comment or like this video or just subscribe if you don't. Thank you very much for watching and have a nice day.